Break-even analysis is a fundamental concept in the world of business and finance, serving as a critical tool for managers and entrepreneurs to understand the financial dynamics of their operations. At its core, break-even analysis involves calculating the point at which total revenues equal total costs, meaning the business neither makes a profit nor incurs a loss. This break-even point is significant because it helps businesses determine the minimum level of sales needed to cover costs, guiding decision-making on pricing, budgeting, and financial planning. The importance of break-even analysis cannot be overstated. It provides a clear picture of the financial health of a business and assists in strategic planning. By understanding the break-even point, businesses can make informed decisions about cost control, pricing strategies, and investment opportunities. It helps in assessing the economic viability of new products or services and provides insights into the potential risks and rewards associated with scaling operations. Consider a small bakery that wants to introduce a new line of gourmet cakes. By performing a break-even analysis, the bakery can determine how many cakes need to be sold at a given price to cover the costs of ingredients, labor, and overhead. Similarly, a tech startup developing a new app can use break-even analysis to understand how many app downloads are required to cover development and marketing expenses, allowing them to set realistic targets and allocate resources effectively. The concept is widely supported by financial experts who highlight its usefulness in providing a straightforward method for evaluating business performance and guiding strategic decisions. However, challenges exist, such as the assumption that all costs are either fixed or variable, which might not reflect the complexity of certain business models. Additionally, break-even analysis may overlook qualitative factors like market trends, customer preferences, and competitive dynamics, which can also impact financial outcomes. Opinions diverge on the reliance on break-even analysis, with some critics arguing that it oversimplifies financial planning by focusing solely on linear cost and revenue relationships. Others suggest that it should be used in conjunction with other analytical tools to gain a more holistic view of business performance. Break-even analysis is integral to the broader context of financial management and business strategy. It influences pricing models, affects investment decisions, and provides a framework for evaluating business risks and opportunities. By setting the context through a comprehensive understanding of break-even analysis, businesses can enhance their strategic planning and operational efficiency, ultimately striving for sustainable growth and profitability. Break-even analysis is a fundamental concept in financial management and strategic planning, serving as a tool to determine when a business will be able to cover all its expenses and start generating profit. At its core, break-even analysis identifies the point at which total revenues equal total costs, meaning there is no net loss or gain. This threshold, known as the break-even point, is crucial for businesses to understand in order to make informed pricing, production, and investment decisions. The significance of break-even analysis lies in its ability to provide a clear picture of a business's financial viability. It helps companies assess the level of output or sales needed to avoid losses, thus aiding in forecasting and financial planning. By understanding the break-even point, businesses can set realistic sales targets and pricing strategies, ensuring they cover fixed and variable costs and achieve profitability. In real-world applications, consider a new cafe that needs to decide on the number of cups of coffee it must sell daily to cover its costs, which include rent, salaries, and supplies. By performing a break-even analysis, the cafe owner can determine the minimum number of sales required to keep the business afloat. Similarly, a manufacturing company planning a new product launch can use break-even analysis to calculate the production volume needed to offset development and operational costs, thereby guiding its pricing and marketing strategies. Opinions supporting the use of break-even analysis often highlight its simplicity and practicality. emphasizing its role in reducing financial risk by offering valuable insights into cost structures and profitability thresholds. However, the concept is not without challenges. One major critique is that break-even analysis assumes costs are either fixed or variable and remain constant, which may not always be the case in dynamic markets. Furthermore, it doesn't account for fluctuations in consumer demand or market conditions, potentially leading to oversimplified conclusions. Despite these challenges, break-even analysis is intrinsically linked to other financial assessments, such as profit margin analysis and cost-volume profit analysis. It influences decisions on cost management and resource allocation, effectively serving as a foundation for broader financial strategies. Understanding break-even analysis equips entrepreneurs and managers with the foresight needed to navigate financial uncertainties, ensuring they make strategic decisions that align with their business objectives and market realities. Calculating the break-even point is a fundamental concept in financial and business analysis, serving as a crucial determinant in understanding when a business or project will become profitable. The break-even point is the stage where total revenues equal total costs, meaning the business is not making a profit, but also not incurring a loss. It is a critical metric because it helps businesses determine the minimum output they need to avoid losing money, facilitating informed decision-making about pricing, production, and budgeting. The significance of calculating the break-even point lies in its ability to provide a clear financial target. It is essential for strategic planning and financial projections, as it allows businesses to evaluate the viability of new products or services, assess the impact of cost changes, and optimize pricing strategies. By understanding their break-even point, businesses can set realistic sales targets, allocate resources more effectively, and reduce financial risks. In real-world applications, the break-even analysis is invaluable. Consider a startup launching a new product. By calculating its break-even point, the company can determine how many units it must sell at a given price to cover its fixed and variable costs. This information is crucial before committing significant resources to marketing or production. Another example is a restaurant considering menu changes. By conducting a break-even analysis, the owners can assess how price adjustments or changes in ingredient costs affect profitability, helping them make data-driven decisions about menu pricing. Supporting this concept, many financial experts and business strategists emphasize its importance as a foundational tool for financial planning and risk management. However, challenges exist. Calculating the break-even point accurately depends on reliable cost and revenue estimates, which can be difficult in dynamic or uncertain markets. Moreover, it assumes that all units are sold at the same price, and that all produced goods are sold, which may not always reflect reality. Some analysts argue for incorporating more complex models to account for market fluctuations or customer behavior changes. Despite these challenges, the break-even analysis remains a vital component of broader financial strategies. It connects directly to other aspects of business planning, such as cost control, pricing strategies, and investment decisions, influencing how businesses allocate resources and strategize for growth. Understanding and calculating the break-even point equips businesses with critical insights into their financial health and sustainability, ultimately leading to more informed and strategic business decisions. Interpreting break-even charts and graphs is a crucial step in understanding break-even analysis. At its core, break-even analysis involves calculating the point at which total revenues equal total costs, meaning the business is neither making a profit nor incurring a loss. Visual representations, such as charts and graphs, are frequently used to depict this analysis. These tools help businesses quickly comprehend complex data, showcasing relationships between costs, revenues, and output levels. The break-even point is often illustrated where the total cost and total revenue lines intersect on a graph, providing a clear visual cue of where profitability begins. The significance of interpreting these visual aids is profound. Break-even charts and graphs enable stakeholders to quickly gauge the financial health of a business and make informed decisions. They help identify the sales volume needed to cover costs, highlight the impact of price changes, and serve as a diagnostic tool to understand the financial dynamics of the business. For instance, a managerial team might use a break-even chart to decide whether a new product launch is viable or to assess the financial impacts of potential cost-cutting measures. A real-world application could involve a startup that is considering entering a highly competitive market. By employing break-even analysis, the startup could visually assess how much of their product needs to be sold before they see a profit, helping them strategize marketing efforts and pricing policies. Another example is in the manufacturing sector, where a company might use break-even analysis to decide on investing in new machinery. By visualizing the break-even point, they can compare the cost of investment with the expected savings in production, ensuring financial prudence. Supporters of break-even analysis argue that it is a practical tool for small businesses and startups as it provides a straightforward assessment of financial viability without the complexity of more extensive financial forecasting methods. However, interpreting break-even charts and graphs is not without challenges. Critics suggest that break-even analysis can be overly simplistic, not accounting for real-world complexities like variable costs or market fluctuations. Additionally, it relies on assumptions that may not always hold, such as constant sales prices and cost structures. Understanding break-even points through charts and graphs interconnects with broader financial planning and risk assessment. By getting a grasp on where break-even lies, businesses can align their strategies to optimize cost management and revenue generation, which influences budgeting, resource allocation, and long-term planning. This understanding serves as a foundation for more advanced financial analyses, linking directly to the wider topic of achieving financial sustainability and growth.